Good afternoon, ladies and gentlemen. This is Darius Dale here, senior analyst of the Hedgeye macro team, otherwise known as the fatter, darker half of the Keith McCullough and Darius Dale show. Welcome to the first episode of In the Trenches, where we're actually going to be focusing mostly on investor process rather than prognostication. I'm joined by my friend and a longtime friend and very thoughtful investor, Nick Reece from Merk Investments. How you doing, Nick?
Great, Darius. Thanks for having me.
Yeah, I appreciate it. Thank you for making it all the way up. Like I said, so what we really want to focus this show on and these segments on is really just something that I find that really makes me tick and gets me out of bed in the morning is really just process. How to build and execute and iterate and evolve your process to make yourself more resilient, make your returns more robust, and obviously ultimately sort of deliver better solutions for your clients or your own PA. Obviously, a lot of investors watching this trade their own assets. So again, thank you guys for joining us. And towards the end of the segment, we're going to have a live Q&A session as well. So be sure to pop as many of those into the chat stream and try to get to as many as we can before the hour's over. So let's just start with you. You obviously are a portfolio manager at Merk Investments. What does that mean? Who is Merk Investments? Who are your clients?
Right. Yeah. So I'm an analyst and portfolio manager at Merk Investments, which is a money management company based in San Francisco. Always had a strong focus on the company's always had a strong focus on global macro, and started by Axel Merk, originally running a separately managed accounts business, and then launched some U.S.-based mutual funds, which we still run, and then have recently restarted an SMA business. I focus on the private wealth management side of that, and a lot of the input on my investment decisions comes from the research work that I publish and that you see on a regular basis.
Yeah, absolutely. It's fantastic research for those of you guys who haven't seen it. So Nick, I think Nick does some of the best long-term cycle work that I see certainly on a regular basis. I don't necessarily see much sell-side research or have much use for it. Obviously, we're buddies, so we see each other's research. And again, you're all about pulling the charts back. You're all about sequencing the data. Yeah. You're all about sort of where are you now? What's the most likely outcome from there, and I find that to be quite refreshing because I think so much of what I think people think macro investing is or macro risk management is, it's just jumping from headline to headline. You wake up in the morning and whatever Bloomberg tells you is the headline of the day, that's what you're going to go down a rabbit hole chasing, looking for incremental data points on. And I think guys like you, guys like me, we're actually quite the opposite. We're jumping from time series to time series. Okay, where are we in this time series? What's the probable range? What's the most likely sort of spot in time, and to anticipate an inflection? And ultimately, what does that mean for markets? So walk me through, or walk our audience through, some of the types of analysis you produce and how that sort of feedbacks into your investment decision-making process.
Sure. Well, I fully agree with you that it's all about the process and the excitement of getting up each morning and looking at the incoming data.
Some would call it boring, but
well, and that's it. Yeah, I think that's fair. Sometimes it is boring. It's certainly, this morning I got up and there was the NFIB report out. Tweeted the NFIB business optimism chart. No likes, no love. Because there are other things to focus on. The Powell testimony, news about the virus. So there are always headlines that are drawing our attention away from some of this data that is boring, but that is ultimately, I think, really important to keep an eye on. So what I do is I publish a monthly business cycle report and a monthly equity market report, as well as Fed reports for every Fed meeting. Yep. And I go through, I think one of the distinguishing factors or features of what I do compared to what else I see is that I go through a consistent set of data each month. And I put that data through a consistent set of frameworks so that there's an intellectual consistency to it.
Totally.
And it's not about trying to say the narrative is this or that. It's always going to be some gray area. It's always going to be a probabilistic way of looking at the world. So the two key questions that I'm trying to answer, one with the business cycle research work is, what's the probability that the U.S. economy is headed into an imminent recession?
Oh, I like that.
And by recession, what I'm talking about are the official NBER recessions. So the NBER are the official gatekeepers of recession. So when I put these recession bands on my charts, that's where that data comes from. And it's important to note that the NBER does not announce the month that a recession starts, that's the beginning of a recession.
Oh my goodness.
That would make life a lot easier. But I think for the early 2000s recession,
it took 8 years.
Yeah,
it took 8 years for them to officially call that 2001 slowdown a recession. It was actually the smallest recession in U.S. history.
Yeah, so these recessions aren't announced until well after the fact, both in terms of the start dates and the end dates. So having leading indicators is really important. But it's also, I think, worthwhile to have some solid coincident indicators because if you have an indicator that gives you a really good read of when you are on the front edge of what's going to be an official recession, that's still valuable information.
Totally.
So that's on the business cycle front, and then on the equity market front, it's really where are we in this bull market? How much stamina is there left? Basically, it's the question of here we are again at new all-time highs today on the S&P 500, and the S&P 500 is basically my unit of analysis for the equity market work. In part because it has the best data, it goes back the furthest. It's just the easiest to analyze for historical cycles.
And for better or for worse, it's everyone's bogey.
Although I'd say, you do still hear a lot of the Dow on TV, and that always makes me think, people always quote Dow points when it's down, right? 1,000 points down.
Nick and I are millennials. We have no idea what the Dow is.
It's still,
that's tongue-in-cheek, obviously.
It's still, what Trump tweets about, what CNBC reports, what a lot of people focus on, and I think the S&P is a better constructed index, at least than the Dow. So that's the focus of that report, and basically the question is, here we are at a new all-time high. Is this a major market top or not? Does this look historically consistent with what we see when we do see major market tops, or is it likely that this bull market's going to continue to make new all-time highs before the next bear market, which we don't have in my view, a great definition of a bear market. I mean, I guess I use what most people use, which is a 20% or greater
decline.
peak to trough drawdown.
That isn't immediately recovered. So we've seen some near 20% declines, like Q4 of 18, 2011, obviously, and then obviously 2016, the lows of 16, but immediate recoveries, obviously.
Right, and also those, if you look at it on a daily closing basis of the S&P, they never exceeded 20%.
Oh yeah, on closing basis, right, man.
I mean, the Q4 18 was 19.8% on a daily closing basis. But if it had been 21%, would we all be saying that was a bear market and it wasn't? I mean, it's a little arbitrary, right?
It's very arbitrary.
So, it's often said that the economy and the stock market are separate things, and I would agree with that. One of the first slides in my business cycle report shows as far as the history goes back on the Bloomberg data, which is to the mid-1920s, the S&P in log scale mapped against the recession bands. And you can see bear markets outside of recessions, and you can see recessions that don't have bear markets. So like in the early 1990s, we had a recession but no bear market, but there was about a 30% drawdown in 87, which was really mostly the 87 crash, but no recession. So you can have one without the other and vice versa, but if you look historically, you can clearly see that by far the biggest bear markets and the ones that take the longest to recover are the recession bear markets.
Absolutely.
So I'm really looking for monitoring these two somewhat separate things, the economy and the market, and looking for that time when maybe the economy and the market are becoming the same thing at the same time in a negative way.
Yes.
With the idea of that you really, as an investor, want to avoid the big recession bear markets.
Absolutely, and that's really interesting because one of the things I find very valuable about your work, or just being able to have access to seeing those reports, is the fact that you, much like Keith and I, sort of separate church and state from the perspective, okay, what's the economy doing, and then what's the market doing? What are the market signals implying as it relates to that reflexive feedback loop? And clearly that reflexivity tends to sort of correlate to one when you're getting into and into the depths of a recession. So that's something that's clearly present and top of mind to most investors now, given where the yield curve is, and obviously given the direction of interest rates in the U.S. dollar. On this business cycle report, so walk me through like how you ultimately determine your conclusions, and quite frankly, who are your conclusions for? Are they for you to make investment allocation decisions? Are they for your clients to sort of either walk them off the ledge or push them over the ledge, walk them away from the ledge or push them over the ledge in terms of their asset allocation decision making? Like what specifically is this analysis used for?
Yeah, it's really for long-term investors, whether it's me managing private client accounts or whether it's investors that are managing their own accounts. I think the biggest mistakes that people make are either being underinvested and scared to be in the market because they're always being told, or they always think it's a major top, or a recession is imminent, because you do hear that a lot. If you look around financial media, you hear a lot of negativity, a lot of calls for bear markets, a lot of calls for recessions. So also for me, it's to give me confidence to be invested when we're in an expansion bull market, and to not be scared out of being in the market, because I think a lot of times people think that being long, let's say being long the S&P 500 as an index, is so easy, but behaviorally it's actually not necessarily that easy.
No, of course not.
Number one, to be confident enough to be fully invested, or to be putting new cash to work when we're 11 years into a bull market or into an expansion, and then conversely to not panic sell when you're down 19.8% on Christmas Eve of 2018, when everybody's saying that this is going to be another. Because one thing to remember is that the last two bear markets that we've had have been big bear markets. It's been about 50% drawdowns in the early 2000s.
And that's on the SPY. I mean, you're talking 60-70% drawdowns
yeah,
on things like the Russell.
Yeah, I'm talking about the
equal weight
S&P
index.
500. Yeah. And so in the early 2000s, you had about 50% with the dot-com bust, which we did have a little recession then, and then of course we had the Great Recession, financial crisis, about 55% drawdown. So I think that it's in recent memory that, hey, if we're going to have a big market downturn, 20% is just the beginning. It's going to be down, 50, and who knows what the next recession is going to look like, what the next bear market's going to look like. But I think that that's what's in people's minds when you get that Q4 2018 type of a drawdown. And so if you don't have a process, if you don't have data that you feel confident in to give you guidance, then I think you're really at the risk of making an emotional, panic sell decision. So that's the way in which this research and analysis is applied in practice.
Gotcha. Yeah. No. So you're really speaking to the top-down asset allocator, whether it be you making the decisions for the clients or the clients making decisions for themselves, which I think is a really important aspect of investment decision making. So let's go into your process. What are the sort of key indicators, and everyone wants to boil it down to one thing, obviously. It's what's the one data point that's going to make you go from state A to state B, but in reality it's a sequence of data points, it's a sequence of analyses that either affirm your convictions in a particular outcome, or they mitigate your conviction in a particular outcome and raise the probability of a different outcome.
Right.
Let's talk about some of the things you're currently seeing in the context and in the lens of that process.
Yeah, so I think the process fundamentally is to decide what is the relevant data. I guess the first thing is to step back and say that there's a difference between analytical thinking and strategic thinking.
Yes.
Right? And so strategic thinking is all about what am I trying to achieve. And so that's a little bit about what I was just talking about in terms of if you're an investor, you're trying to compound you're trying to compound capital at an attractive rate of return over a meaningful period of time, which for most people is decades, with a high likelihood of actually achieving those returns. How would you go about doing that? Right, and I think that being long U.S. equities historically has been one of the best ways to achieve attractive returns, with the exception of those big bear markets. So that's kind of from the strategic sense of thinking about, okay, how do I want to go about approaching long-term investing, and then so you have to say, okay, what's the relevant data that I want to track, and then what are the frameworks that I want to apply to that data in terms of interpreting it. So what's going to be negative and what's going to be positive? If it's something like manufacturing PMIs, you could have a dividing line that is at 50 that divides expansion from contraction, and if it's above 50, it's a positive signal. If it's below 50, it's a negative signal. So you want to have those frameworks in mind, and then have them make sense so that you can keep them consistent through time.
There's something about the consistency that really speaks to being able to do this over time. Right. Because obviously if you don't have a consistent framework, and for us the consistent framework from an econometric perspective is the quads. What is the economy doing in rate of change terms across the three biggest factors that are causal to inter-asset class dispersion? It's growth, it's inflation, it's policy. And more importantly, we're trying to use rates of change and growth and inflation to sort of front run the next sequence of decision making by policymakers.
Yep, and I know that your work focuses more on is certainly, I'd say, shorter term than the time frame that I look at things, and it's more, you often focus on the rate of change, which is important. For me, I often talk about how economic data can really be looked at in three different ways. You can look at how does the number come out relative to expectations, how does it come out relative to the prior reading, and how does it come out in absolute terms. So to use the example of the manufacturing PMI, you could have a reading that comes out at 52, which is down from the prior of 53, but better than the 51 expected, right? So almost any data point can be characterized positively or negatively in the headlines, depending on which one of those three ways you want to look at it.
And I say this all the time. We now live in an era, because of things like Twitter, just because the richness and the amount of incremental information that's being generated on a daily basis has never been higher, and that's growing at an exponential rate. So as a function of that, the noise to signal ratio in terms of that we have to sift through as investors has never been higher.
Yeah.
And it's only getting higher.
Yeah.
And so talk to me about how you go about that, because that's a great example of something that there's a lot of noise in each one of these economic releases. How do you get to the conclusion based on all this data that you're tracking?
My favorite thing is to run my charts, and I developed this chart library within Bloomberg that I can just do a batch run and run all these charts and see and look at how the data is coming out. So I think to come back to that point about rate of change versus absolute level, I think those are the two most important things. What I have found is that at least in the long term, how it comes out relative to expectations isn't that important. And maybe that's because the consensus economist expectation isn't necessarily what's priced into the market anyway.
Totally.
But I'd say that rate of change is getting better or worse, and where is it in absolute terms are probably the most two important things to look at. So in terms of the best data for the business cycle, it's really the yield curve, it's manufacturing PMIs and PMIs in general. The LEI index from the Conference Board, which is a little bit of cheating because that's already a composite indicator that they've put together, but you get a nice history of it, and it does a pretty good job and is a good sort of cross-reference to all of the sub-indicators that I look at.
Can we pop some of these? Do you have these charts up in your presentation?
Yep.
Yeah, let's walk through a few of these. I'm definitely interested in seeing sort of your take on a lot of the data that we're tracking across our nowcast model. So it's with respect to the U.S. economy specifically. We have a nowcast model that imports features, the rates of change, and absolute levels of features across the various segments of the economies. And what we're just effectively trying to do is understand where GDP is likely to be in the current quarter, and then we layer on a comparative base effect model that's also proprietary that extrapolates that momentum in the future on an investable time horizon that we would consider to be investable, which is up to a year. In terms of the asset allocation pivots we're trying to get investors to make. And so that those two models sort of coalesce to give us that sort of intermediate term view of what kinds of assets we should be long and how much exposure to something like equity beta we want to be exposed to, and what types of sectors and style factors should lead and lag within that. But just going back to your process, so let's walk through a few of the indicators that you're looking at to sort of get to those conclusions as well.
Sure. I think maybe the most interesting one, if we can put it up on the screen, is the
slide number.
Do we need a slide number?
Yeah, probably helpful.
So slide number, I think it's slide number 5. Or slide number 4 would be the 10-year versus the 3-month.
Yep.
Yeah, this one right here. Yeah, so I have two yield curves, and I think that it's important to look at both. So this is the 10-year versus the 3-month, and you can see that we did have an inversion last year. We were inverted from May to October, and that was the first time that we had yield curve inversion for this entire expansion. And we've always had it prior to recessions. Now, the sample size is relatively small. We only have 7 recessions here for the data going back. That's as far as we can go back to get the interest rate data, at least reliable interest rate data. So we did get inversion last year, and you can see just looking visually at the chart. And I think in general, my approach is very much based on data visualizations. I think pictures are worth 1,000 words, and you can capture a lot of information very quickly. Looking at
pictures and color coding.
Yeah,
that's my specialty.
Exactly. And so you can see that we've always had inversion prior to recessions, and there haven't been many false signals. So I think we had one false signal in the mid-60s. And the question is, this inversion that we got last year, is that a genuine signal, or is that going to be a false signal? And it's a little bit too early to tell, because typically when you get the inversion, it's about a 6 to 18 month lag until you would potentially go into recession. So even though, one of the classic headlines that we got when we were headed for inversion early last year, this was back early last year, and even in
April
2018, because the curve has been flattening this whole expansion.
It peaked in 17.
Right? And what you would see are these headlines saying the yield curve is as flat as it hasn't been this flat since 2007. But that's very deliberately misleading, because, of course, in 2007 it wasn't flattening; it was steepening at that point.
Exactly.
So the proper analog would be 2005 rather than 2007.
Bingo. That's the rate of change analysis. Yeah.
And so now the question is, okay, well, was this inversion from last year a genuine signal? If we go to the next slide, I think it's slide 5, the 10-year versus the 3-year, that shows a different picture, because we actually have not had inversion on this metric of the yield curve, whereas we have always had it in the past. So what I was about to say earlier is that there's no amount of historical data that means that we have to get inversion before the next recession, of course. But if we're using history as a guide, then it seems to me more likely than not that we actually probably are going to see this yield curve invert prior to the next recession. But overall, the yield curve analysis is a mixed picture because we've had inversion on the 10-year versus the 3-month, and it's rare to get false signals there. But we haven't had it on the 10-year, 3-year, where we always get it prior to recession. So my characterization as far as the yield curve goes is neutral to negative.
Yeah.
Have to respect the fact that we got the inversion on the 10-year, 3-month, but there's a question mark around the fact that it hasn't been confirmed by the 10-year, 3-year. What I suspect is happening there is that, and I think we can probably show this on slide 29. Let's see if that's it. So this disaggregates the yield curve into the two pieces, which I think is also important to look at because there are different kinds of flattenings and different kinds of steepenings. And the way that we had this inversion is not typically what you see, because normally what you see is that inflation's picking up in the business cycle. You've run out of slack in the economy, both in terms of available workers and installed fixed capacity. So capacity utilization is very high. You get inflation building up, and the Fed, because of its mandate, has to come in and fight inflation and hike rates. And then it hike rates, and continued rate hikes are expected and priced into the curve 2 years out, 3 years out. And that moves above the 10-year, and then you get inversion with both the 10-year and the 2-year or the 3-year moving higher. But in this case, we got inversion with both moving lower. And so I think that that's an important distinction to make between what's happened with this inversion and prior inversions.
Absolutely, and I think that's you hit on something that's really critical. I think it in charts in general. If you go back to the 10-year, 3-month chart, slide 9 again, the 10-year, 3-year,
I think it's
slide 4 rather. I think this is something that's so critical, and it's particularly for younger investors. I mean, you and I are in our mid-30s now. You know, we've been doing this for what I would consider to be a decent while, but certainly not long enough to be able to recall those blue bars, off the top of our head. And so I think something that's really important to me is really this whole concept of sequence. Like the amount of time and space that it takes from these inversion points, from the points where the data says, I'm signaling, one of these blue bars on a pending basis, and you actually get the blue bar. To me, it's so important because, again, I think a lot of investors, particularly investors, because we live in this macro touristy, headline-driven world, they say yield curve inversion, recession risk.
Yeah.
They miss the fact that the year leading up to most equity bull market peaks is actually one of the best years of every equity bull market. It's typically characterized by double-digit returns and growth, high beta momentum, upwards of 20 to 30 to 50% for pick your cycle. And I think a lot of investors kind of forget that. And that's kind of the key takeaway. It's where are you in the cycle? Not just saying I'm in the stadium, I'm in the town where the stadium is in, but exactly what inning are you in this particular game that we're calling this cycle, and that's something I've been doing a lot of work on as well.
The other thing about that reminds me of is that when you get these headlines from going as far back as 2018, maybe even 2017, that the yield curve is as flat as it's been since 2007, people hear that, it's like the boy who cried wolf. It's like you've been telling me it's 2007 on the analog for 3 years, for 4 years. Where's the recession?
Totally.
So I think people get tired of hearing, they get yield curve inversion fatigue in terms of the headlines over the years because it just keeps getting berated as a talking point and as a headline. And then if you think about it, the fact that it's been such a reliable indicator in the past, I think it almost has to be the case that it gets shrugged off when it happens. There's always a reason why it doesn't matter this time. And that's the thing to be really careful about.
Well, now there's the number of reasons why it's not going to happen this time are infinite and growing at an accelerating rate. That's the nature of this macro tourist machine that we live in.
So I have to be wary because I think that I'm on the fence and I have to cross-reference all the other indicators as to whether I think the inversion from last year is a genuine recession signal. And I'm leaning towards it's probably not. It's probably more of a false signal. But I have to be wary of the fact that I don't want my brain playing tricks on me and saying that because everybody, the consensus has to be that it's different this time and that we're not imminently going into recession. I don't think that the consensus is that you're going into recession if you look historically at the points where you actually do.
Oh, no, totally. We know what the consensus is. If you put up slide 74 in the macro theme stack, Josephine, we know what consensus is. Consensus, at least prior to this most recent coronavirus outbreak in terms of its impact on markets, very clearly quad two in our vernacular. So quad two is a situation where growth and inflation are accelerating at the same time. And again, this is all pre the 23% collapse in crude oil.
Yeah.
Census came into the year long crude oil, long small caps exposure, short the dollar and short treasuries. And what that tells us, based on the historical back test for all these particular asset classes and factor exposures, is that the census expects a quad two recovery.
Yeah.
Now, if you go back to, you look at something like slide 13 in this deck, Josephine, where have we been in terms of the rate of change in U.S. growth? We've been basically on the backside of this U.S. sine curve for, really since the cycle peaked in 3Q18. So from that perspective, we know what the path towards recession looks like. It's not obvious for every investor, right? Growth is slowing, and at a certain point you hit a stall speed, and at a certain point the labor market gets too tight, at a certain point the Fed has tightened too much, and at a certain point, that's when all the correlations start to go to one as it relates to firing, the depressing impact on profits and consumer spending and business confidence. All these things really start to correlate, and so it's really just about understanding that the system has vulnerabilities, but then monitoring diligently for the trigger that would cause the system to sort of quote unquote break. What do you have in your report that would seem to be a more of a signal of a trigger from that perspective?
Well, I guess that leads into more of the analysis on the market itself. Generally speaking, I think being in a business cycle expansion is certainly a positive backdrop for equities. But as we talked about, it's not one for one. And so a couple of the things that I really look for on the market side. And this is one that we've gotten updates to in the past couple of days, which has been good, is that every time the S&P 500 makes a new high for the bull market, I measure the breadth in a few different ways. But one of the ways is what percentage of member companies are above their respective 200-day moving averages. And if you look at historically, what happens in bull markets is that breadth is very strong, participation is very high early in the bull market, and then as the bull market ages, that participation declines, the breadth declines, and then it gets to what I would describe as a critical level. And my critical level historically is about 63% participation. If you're making new all-time highs on the index, but fewer than 65% of the component stocks are above their 200-day moving averages, that's a sign that that's a very old bull market that's likely to turn over. And the classic example of that was in the late 90s when breadth just got extremely low. I think it was in the 50%, 40%, something like that. So then we make these new highs, and you can ask the question, does this look historically consistent with a major market top or not? And as far as the breadth analysis goes, it's actually pretty strong. What we saw is that it was pretty low last year as we were making new highs, and then recently, when it made a new all-time high, I guess when it was making new highs in January, I think we got as high as on the 17th of January, we got as high as 87% participation. Which is very strong. And so we haven't seen it that strong since 2014. So that's very inconsistent with a major market top, and suggests that there's potentially quite a bit of room for the market, to continue higher, which I think is surprising a lot of people because, or at least, there's certainly a group out there that pushes back against that, talking about how far it's come from the Q4 2018 lows. But one chart that I have in my equity market report is that if you look at the S&P, the index, we were at the same level at the peak in January of 2018 as we were at the low in October of 2019. So you had 21 months of sideways movement on the S&P with a lot of downside volatility. And we've had periods like that in the past, I think in 2011, 2012, 2015, 2016, where you had these really poor Sharpe ratios on the S&P.
Yeah, very poor Sortino ratios as well.
Yeah, exactly, because it's all downside volatility. And it's very flat. And then you get these surprisingly strong advances coming out of it. So I think the S&P was up 45% coming out of that sideways consolidation in 11-12, and then 35%, something like that, coming out of the consolidation in 2015-16. So we could be still in the relatively early days of this advance out of that consolidation that we had in basically in 18-19.
Yeah, no, and to me, it's also, a lot of your analysis is focused on the capital allocation decision to be long stocks versus bonds, et cetera. And a lot of our work focuses on, what are you long within the equity market? If your goal is to outperform, I say this all the time, don't be beta, beat beta. You have an opportunity as an investor, so what are you long? It's jump to slide slide 138, Josephine, in the macro theme stack. There's a lot of the work I've been doing recently is just about this whole concept of excess liquidity, right? Like, everyone,
Yep.
it's the excess liquidity is what I would consider to be consensus nomenclature for the death of process. I'm just gonna buy the SPY and the Fed, and I'm gonna show up to work at 9:29 and just be long the SPY, and at 4 o'clock I'm going home because excess liquidity.
Yep.
But again, it's not about excess liquidity, right? Like, it's about if you want to be long the SPY and as a professional investor conduct the 9 basis points, go work at State Street. If you actually want to earn your keep for your clients and actually deliver them a superior risk-adjusted return, it's about, from our perspective, it's about using the cycle to time these sort of big invested allocation decisions. So actually, Josephine, go back to slide 135, actually. I use this all the time. Don't be beta, beat beta. If you look at the last 4 years of investing, right? And so what we're showing here in this chart in rate of change terms is all of the top 15 features in our nowcast model for GDP, the key drivers in our inflation model, and the sequence of corporate profits. And what you see, just looking at the growth component, just from a rate of change perspective, you really only had to go to work twice. I mean, you have to go to work every day to sequence all this data,
right?
But you only really had to make 2 material asset allocation decisions from the perspective of what are you long within the market, and that's the second half of 2016, and then heading into Q4 of 2018. Jumping back to slide 138, it's like and we were there for that, for both periods. We're persistent quad 1 and 2 from mid-November 2016 up until the end of September of 2018, and lo and behold, when you look at something like cyclicals, looking at the Russell 1000 Dynamic Index, that's up 40% relative to the 20% return you saw in something like utilities. Right. But if you make that full cycle investing pivot on time, and you're long utilities since then, you're up 40%, whereas cyclical is only up 11%.
Yeah.
And so it's like, I don't just want to be beta. I mean, it's a very important asset allocation decision you need to make as an investor, certainly in the context of heading in potential recession, over the next 12 to 18 month time horizon. But it's also, I want to make the most amount of money along the entire ride. Right. And that's something that, I think that's a really important important sort of distinction between maybe our processes, but not necessarily our conclusions.
Right. I think that if at this point you're long the index and expecting that you're going to make 15% total return on average for infinitely, you're going to be in for a surprise, because eventually, I mean, this has been a tremendous bull market, but I think, and it depends on who you're working for. If you're working for a fund, I think you have a different set of constraints and expectations than if you're working for a family office or a private client.
Absolutely. And that's the difference.
Because to my way of thinking, beta's fine if the beta returns are good. I mean, if we're talking about the total return on the S&P 500, I just looked at the data this morning. For the past 11 calendar years, 2009 through the calendar year of 2019, the average has been about 15% total return, with the biggest down year being in 2018.
Go to 133. I mean, this chart is absurd.
Yeah. So I think if you were a hedge fund manager producing those returns uncorrelated to the market, you'd be in world-class territory.
Yeah. The problem is, if you're one-to-one correlation with the market, you're probably not earning 2 and 20.
Right. Of course.
Of course. And that's one of the key takeaways there. And jumping to slide 113. I mean, look at the changing of the market structure, right? Like, 20 years ago, 130 rather. 20 years ago, 89% of the AUM, and looking at U.S. equities in particular, was in active managed funds. Mm-hmm. Now it's only 50%. So the world is moving your way in terms of having to make those decisions at the asset class level. How much beta exposure do I want to be? But for the people who are left in that 50% bucket, increasingly duking it out over what seems to be lower management fees, lower performance fees. We live in an era of fee deflation. That's something we just have to acknowledge as active managers and people who service active managers. And so it's really about, okay, can I give you the tools that you need to stay fully invested at the client level? Right. And then can I give you the tools that you need to succeed and deliver superior risk-adjusted returns at the active manager level? And I think both can be done. Yeah. Quite frankly, that we wouldn't have an industry if both couldn't be done. And you look at a lot of different business cycle indicators and market indicators to get that to that beta answer. And I think one of the ways in which we do that is kind of similar. If you just throw slide 143 on Josephine.
But by the way, just quickly, the conclusion isn't always going to be to stay long. I think
no,
that's
of course,
that's the whole point of doing the homework.
That's the whole point of doing homework. The conclusion has been to stay long, and it's been the appropriate conclusion. And our conclusions have been from the back half of 16 to the end of Q3 of 18, it was to be offensively positioned.
Right.
Be long stocks, be long cyclicals, be long high beta, be long momentum. And since then, you've had demonstrably superior risk-adjusted returns and absolute returns being defensively positioned. Bonds are outperforming stocks by 1,000 basis points since then. You got low beta stocks outperforming high beta stocks by 20,000 or 2,000 basis points since then. That's kind of the whole point. It's like I want to constantly put myself in a position to make the most amount of money with the least amount of risk.
Yep.
And that's sort of that's kind of where we differ in terms of the shorter cycle nature of our process.
Yeah.
But I don't think the longer term conclusions are any different, right?
Right.
Where are we in the business cycle? What does that mean for your asset allocation decision-making process?
Yeah.
And going back to slide 143, I think about the world very similar to you. Where are you in this cycle, and how much time and space do you need to be able to pick up? I don't want to say nickels in front of a steamroller, because a recession is a steamroller. But that phrase sort of implies that the steamroller is very close. If this is 2005 and the recession is going to hit in the end of 2007,
right.
You're not going to have a job as an active manager by 2007. That's just the fact of the matter.
Yeah, well, that's one of the constraints. Although in that example, I mean, it depends on how much further there is to go. I mean, you could have. I mean, there are many people who have been bearish since 2013.
Yeah.
That I'm aware of.
I know a guy running an anonymous blog that's been bearish the entire time since I've been in finance.
Right. And so if you say, because some people say, well, but we've gone so far, so why not be defensive? But then you have to think, you have to run through the actual exercise and maybe run it on a spreadsheet of, if I get let's say you get defensive today, but the market goes up another 15% over the next 2 years, 15% each year for roughly a 30% gain from here. And the next bear market isn't going to be like the last two where it's a 50% bear market. It's going to be a more average 30% bear market. You'd have to be an expert market timer to get back in where you got out. Mm-hmm. So you have to be very careful, I think, about how defensive you want to be and how early. A lot of people, 2015 got defensive, and then we did have that down market in the second half of 15, early 16. Mm-hmm. But where were we on the index back then? 21, 22, 2300. I mean, we're 1,000 points higher on the S&P from there.
Totally.
So we got a long way to go to get down there. We may never get back down there. So if you were taking risk off the table along the way, it's unclear that you're actually going to be able to deploy that capital that's been in cash back into the market at more attractive levels.
Yeah, no, totally. That's actually a mistake I made. My first year that I actually had enough money saved up to start investing was 2011. And I remember we made this negative market call in 2011, and Kevin Kaiser used to run our energy desk here. He and I were like, if the market gets back to 1,000 on the S&P, we're going to go all in on stocks.
Right.
It didn't get to 1,000.
Right.
I didn't buy a single stock until 2013.
And then you've got a cash drag, right?
Yeah.
So that's the part about strategic thinking that you've got to think about weighing basically the cost of acting versus not acting, and what I think the downside is underperforming what you could do. On the flip side, you got to accept the potentially greater volatility, or that you might not get the recession call or the bear market call. Perfectly right.
And for us, it's all about, again, like I said, it's about what are the quads? Like if you're in quads 1 or 2, you want to be offensively positioned. In quads 3 or 4, you want to be defensively positioned. And at some point, you're going to take your ball and go home. And that's kind of the point of your analysis, and some of the analysis I've been working on lately is, when do you take the ball and go home? When is it no longer cool to be long consumer staples, or utilities, because those things get dinged in recessions too. Yeah. All right, let's open up to some Q&A. Just a reminder, you guys, there's the most popular questions. Hopefully we'll get addressed. So starting with Michael, with 11 upvotes, it says this current market cycle has a strong ability to shake off any shock and headwind, simply by utilizing tools and policies that have historically proven ineffective over the course of the full cycle. I think he means ineffective at stimulating growth. Mm-hmm. How do you reconcile your quad allocation back tests when the market environments are so different? So that's probably a question for me. I don't know if you have any thoughts on that before I hop in.
Well, I guess I would say that that in terms of policy tools, if you're really going into a recession, the Fed rate cuts aren't going to prevent that.
No, totally, never have.
And that was the thing when the Fed started cutting last year, is this going to be like the beginning of cutting in 2000 or the beginning of cutting in 2000.
Yeah, it's 95,
you
96,
know,
it's 98.
Right, because we've also had the mid-cycle cuts,
Yeah.
which we had in 98, 95, even I think back in the late 80s. So Greenspan has done a few of these mid-cycle adjustments that have actually engineered, I guess you could say, soft landings. One of the things I think is funny is that Greenspan, is the maestro for hiking rates preemptively in the mid-90s and then easing again. Whereas there's just absolutely no love for Powell these days, and it's too early to tell whether this is really a soft landing. But I would say that if we're really going into recession, the Fed rate cuts aren't gonna do much.
Because the Fed can cut rates, but it can't cut labor. The number one reason, at least from what we can tell from a backtesting perspective and looking at all the economic data, that we go into recession is you have a market event that is sort of very perilously timed in and around when unit labor costs are destroying corporate profitability.
Yeah.
And you catalyze a sequence of firings that catalyzes, the depressed consumer confidence, depressed consumer spending, and it all becomes very reflexive. And that's how you get the recession. And the Fed can't do anything about that unit labor cost inflation dynamic.
Yeah. But I think there was another aspect to that question that's probably more specifically addressed to your
no,
process.
actually, so I was, prior to you getting here, I was actually, hard at work on some slides, adding, every time we get these types of questions, I happen to throw, and Keith and I are on the road all the time, visiting clients. And what I'll do is, if we get a tough question, or I think is a really relevant question to the discussions that we're having, I'll pop them in the appendix. So, today I popped some slides in the appendix for you guys. So hopefully you guys enjoy these. Just starting with, so specific on this question that like Fed liquidity equals I can wake up at 9:30 and do no more work. So go to slide 131, and we'll fly through these slides really quickly because I do want to make sure we have plenty of time to get the questions. So everyone says Fed liquidity is accelerating. Everything's good. But most people don't realize that money supply growth is actually inversely correlated to GDP, both on an absolute and first difference basis. If you look at slide 132, which is and that chart on 132.
Which metric do you use for money supply?
Just M2. I'm just
M2,
any metric of money supply. But certainly the broader you go, the more tight the correlation will get as it relates to something like GDP. And so I go, okay, well, sure. Most people don't know that, but what most people do know is on 133. Beta's done very well for 10 years, so everyone wants to be beta. They don't necessarily want to beat beta, they want to be beta. But then I remind everyone on slide 134, if you wanted to be beta in Europe and Japan because of liquidity and money supply, you've done absolutely nothing. I mean, right here I'm indexing on the left chart the Eurostock 600 index to its 1H 2000 peak. It's only up 6% from there with a sharp ratio of 0.4.
I know. You
Nikkei's down 37% from where it was today 30 years ago.
Yeah,
there are millennials who are making investment decision makings on the buy side that we weren't alive the last time the millennial was above its the Nikkei was above its high watermark.
Yeah.
Think about that.
It's pretty remarkable.
That is what excess liquidity gets you, folks, if you want to chase a 10-year bull market in stocks, thinking that this is the new wave of the future. And so it's really, again, I can't stress it enough. It's about the cycle.
The underperformance of international has been really, I think, one of the noteworthy features of this 10-year, 11-year bull market. I think one of the things that occurred to me recently, or that I realized recently, is that if you look at the MSCI weightings for the U.S. versus Europe, I think it's 24% tech in the U.S. and 6% tech in Europe. I think that's probably been one of the issues that's allowed those or contributed to those markets lagging.
Well, it hasn't always been the way. I mean, you think of something like software. Software's gone from like 14% of that index to like 22, 23, 24, probably 25 now, actually, with the size of Microsoft. And that's one of the functions. Obviously, they have had great returns, but you've seen a pretty sharp decline in the share of things like energy and basic materials as the dollar has risen off for 9 years off of its 40-year low in 2011.
The other thing, I'm interested to get your take on it, is these S&P 500 companies have about 55% of their revenue from overseas. So these are, and I think we're an increasingly global world. So I think it's more the case these days that you've got a potential, you really get punished for not owning the winners, I think.
Yeah, absolutely. You absolutely get punished for not owning winners, but we more importantly, we think you get punished for owning the losers at the most inopportune time.
Yeah.
There's a time to buy the losers and there's a time to sell the winners.
Oh, absolutely.
It's about using the cycle to time those decisions, to help you time those decision-making processes. You're not going to get everything right. Unless you're Bernie Madoff, you're not going to nail every timing decision you make. But the whole point of being an active manager is to identify those winners and losers and take advantage, use the cycle, use the fundamental data to take advantage of those things. But yeah, to your point on the international, slide 69 in the macro themes deck shows our GIP model backtest for the U.S. dollar index, specifically looking at global growth and inflation signals. And what you find is that the dollar only goes up in quad 4. i.e. when the international economy is slowing into quad 4, nominal GDP is slowing internationally, and it pretty much goes down straight down like a ball of fire in quads 1 and 2, and it goes down less so in quad 3. So what that tells me is that when the international economy is doing good, the dollar goes down, and it's a doubly reflexive positive impact to the winner's corporate earnings. And so much so, it's a doubly negative reflexive impact on the other way around. So that's something to keep in mind there. All right, next question here. Pierre asks, can the melt-up continue to hide cracks in the foundation? Do you have any thoughts on that?
It's hard to know what the underlying assumptions are there, and I might question some of the underlying assumptions.
Yeah, I do too.
Of that question.
I definitely do too. You can go first, but my biggest assumption is that one, we're melting up. We may or may not be melting up. That's neither here nor there. I wouldn't characterize market moves with sort of loose nomenclature like melt up or melt down. It's really just what is happening, both at the level in terms of percentage change at the index level, but also what's happening underneath it from a price volume volatility perspective. Are we melting up with the rising volume or falling volume? Are we melting up on accelerating volatility or sort of decelerating volatility? All of those things matter, and currently that's been the case. Positive, all those signals have coalesced into a positive signal for something like the SPY, but it's not the case for something like the Russell.
Yeah, I guess I think it's important to put things in perspective, and one of the things that especially when you're dealing with long-term charts, it's so important to have a log scale.
Oh my God!
I mean, the distortions that happen, and this is happening right now with the virus cases.
Totally.
I mean, you have to put that in a log scale.
Have to put it in log scale.
So if you look at the bull market in the S&P 500 from the beginning in the middle of 2009 till now, there's a very clean trend channel on the log scale, and we're right in the middle of it.
Yeah.
So, to me, in the top end of that range right now is about 4,000 on the S&P. So, if we had to blow off top and melt top, to me, that we'd have to exceed that upper channel.
Yeah, and then, by the way, that's the history of pre-recession periods. You typically, I kind of mentioned this a few times, but go back to slide 143. We're diligently tracking and sequencing all the stuff that'll tell you, A, if a blow off top is coming, and B, when that blow off top might end. So let's start with the premise that not every equity bull market ends in a blow off top. Let's just start with that premise. At least lately, over the past 3 cycles, looking at this anchoring on the past 3 cycles, you typically have seen sort of mid-teens returns on something like the SPY, and those returns have historically been led to the upside by the growth, momentum, and high beta style factors. That's been consistent across each of these 3 cycles. So, if you're going to say that's going to happen again, that's fine. But this concept of lazy blow off top or excess liquidity, that to me, that's a very lazy discussion. But what is not a lazy discussion, putting that table back up on the chart, is sequencing the time and the space that you need you've historically seen in advance of these things called blow off tops, or what people would otherwise characterize as a blow off top. So we're looking at it, these things from a variety of factors as well. Market breadth, when does the S&P 500 equal weight index peak relative to the index itself? The Russell 2000. We're looking at liquidity dynamics. What's happening with the yield curve? What's happening with 10-year treasuries? How much has the Fed gotten the dollar down? How much has the Fed reflated gold and oil? How much of that is having where's corporate profits? How much deterioration have we seen in corporate profits, in consumer confidence, in business confidence? And then lastly, what I think is probably the most critical indicators, because these are the ones that really start to signal red in advance of the ultimate equity bull market peak, is what's happening in the labor market. So the labor market very clearly is late cycle from the perspective of pretty much any metric you can track. Certainly continuing unemployment claims probably being one of the most relevant metrics you can track from that perspective, and obviously the level of jobless claims, so the spread between the U6 and the U3 rate. These are 3 things that all say we are late cycle. But in terms of where we are in the current cycle, looking at this table again, the trough in things like consumer or initial jobless claims, consumer or continuing claims, the amount of time that has passed from those troughs pales in comparison to the amount of time that has passed historically between those troughs and the eventual bull market. Same with the amount of deterioration. You haven't seen nearly the amount of deterioration in unemployment claims, both on an initial and continuing basis. You haven't seen nearly the amount of deterioration you've seen historically in terms of like the unemployment rate or the rate of change in employment growth. And that's not to say these things aren't going to happen, because they will happen. The whole point about waking up, I wake up every day at 5 every day, Chasing Keith, who wakes up every day at 4:30, it's waking up every day to see when those things go from green
Yep.
to less green to orange
Yep.
to red. And oh, by the way, while we're doing that, we know what quad we're in, so we can know exactly what kind of exposures we want to be exposed to on the long and short side across these different asset classes while we're doing the sequencing process.
It's also important to have a number of different indicators.
Totally.
If you say that initial claims are important, that one of the favorites these days has been the continuing claims.
Yeah.
If you say that's important and then it's meaningful that on a year-over-year basis its rate of change is positive, then you can't ignore it when the rate of change goes negative again. There has to be intellectual consistency.
That's exactly what happened. So we got that actually recently happened in the December. In December, jobless claims data was severely impacted by the calendar shift in terms of pushing the late Thanksgiving holiday materially impacted the year-over-year rate of change in initial jobless claims in December. So we had a false breakout in initial jobless claims in December, but in January, on a monthly average basis, slowed back to down 4.9% year over year. That's the sharpest contraction in initial jobless claims we've seen since January of 2019.
Right.
So what that's telling me is that not yet. There's the recession call, not yet, at least from the perspective of this single indicator.
Right.
And again, it's about creating a mosaic of
and you're cross-referencing a lot of different indicators, and if you're saying it's important at one point in time, then it has to be important to review and cross-reference month to month to month. But so many people, I think, essentially engage in confirmation bias, and you could create a set of all negative charts, and it would paint a very negative picture, or all positive charts, and it would paint a very positive picture. It's important to be looking at all of the relevant data.
Consistency.
Yeah.
Consistency of indicator and consistency of how you score the indicator.
Right.
In terms of that chart. And I'm sure you have a very similar process as well. It's okay, where are you within the range of this indicator relative to previous cycles? Where are you in the level of this indicator relative to previous cycles?
Yeah.
And oh, by the way, how much time has elapsed from when you peaked relative to previous cycles?
Right.
Or when you troughed
because you have
relative to
long
previous
leading
cycles?
indicators. You have ones that are more, kind of, right up coincident indicators.
Exactly. It's about that process of consistency rather than that process of narrative building and sort of confirmation bias. All right, let's get a few more before we wrap up. Rocky's asking, this cycle we've seen central bankers become the market. I disagree with that. Which market are you referring to? By manipulating liquidity, buying risk assets, and supporting zombie companies. How reliable will our indicators of the past be in an era where central banks can move the entire market and punt the cycle further?
Well, I think when it comes to central banks, I think it's just important that they're part of your analysis, and that the expansion of balance sheets is part of your analysis. I mean, to me, I would say that I have a combination of fundamental and technical indicators or analysis that I do when I'm looking at the market. But within fundamental, I would say that what central banks are doing is part of that. The macro backdrop is part of that. Within the technical side, breadth and sentiment and positioning are all part of it. So I like to look at the market through as many different lenses as possible. But I mean, fundamentals to some extent can't be reduced to anything beyond supply and demand. And if you're talking about central bank balance sheets, you're talking about really money and liquidity in this system of financial assets. So to me, it's almost a quintessentially fundamental piece of the puzzle to be looking at.
I completely we've complete agreement there. What does the P stand for in our GIP model? It's policy. We're trying to use the rates of change and ultimately the levels of growth and inflation, but we use the rates of change to forecast the subsequent levels to impart our views on what the central bankers are going to do from a policy perspective. Just rifling through these charts again, go to slide 138. Or actually, no, sorry, not 138, 137. Again, it's not about liquidity and being lazy about central bank liquidity and saying central bankers are the market. It's about understanding what central bankers are going to do next. And the only way you're going to be able to do that is to front run their analysis of the key indicators that they're tracking.
Right.
And so you need to have a process to front run what they are going to eventually see on their screens and what's going to eventually change their behavior. And so I mentioned that, from mid-November of 2016 through late September of 2018, we were consistently forecasting quads 1 and 2 in the U.S. economy. What do quads 1 and 2, particularly quad 2, which is 7 of those 8 quarters, was quad 2? What does quad 2 mean? Growth's growing up at the same time, inflation's going up at the same time. We expect the Fed to get incrementally hawkish at every interval throughout, and that's exactly why you'd be long at the asset class level, stocks versus bonds. Putting the chart back up, stocks from that moment in time returned 40%. That's the chart on the left. Whereas bonds only returned 1%. Looking at the 25-year total return index.
Right.
Since then, we've been persistently forecasting quads 3 and 4. What do quads 3 and 4 lead a central banker to do in terms of looking at economic data? They make them ease at the margins. When we said go buy bonds when bond yields were allegedly going to 4% in October of 2018, we knew the central bankers were still tightening on a lag to the 2 years of quads 1 and 2.
Right.
But we knew eventually if we're right on these forecasts, they're going to have to pivot. And so if you're long bonds, putting the chart back up, since the end of September 2018, you're up 30% on a 25-year Treasury bond. That's way better than the 18% return in the S&P 500.
Yeah.
And so again, it's not about just saying excess liquidity equals SPY. It's about front-running the quote-unquote excess liquidity and being positioned in the right asset classes, the right factor exposures, the right sectors to take advantage of quote-unquote excess liquidity.
Yeah, I think it's extremely important to understand, as you say, the way that the Fed thinks and what their policy response is. I mean, they have a mandate, right? And so Powell is given an assignment, and he says, yes, I can perform this civil service. So, what are they looking at? They're looking. He tells you. He does a pretty good job of actually telling you what they look at. I'd say more so than Yellen or central bankers in the past.
Yellen almost probably told us too much.
And we look at every Fed meeting. We publish a report on the Fed and what they look at and what their comments have been. My guess, historically, what you see in business cycles is that as you run out of slack in terms of labor market capacity, in terms of fixed capacity, that inflationary pressure builds, and then the Fed has to come in to tighten to fulfill their mandate.
Totally.
And that combination of inflation probably being higher than what's expected and what's in household and corporate budgets, which is really sort of a real break on those businesses and households, plus tightening of financial conditions, I think really helps to roll the cycle over. And my guess is that this time we're probably not going to really see the end of the cycle, if it's anything like history, until we get a meaningful buildup in inflationary pressure.
Yeah, no, that's totally. And we've seen that at the unit labor cost side, but it hasn't been pervasive enough to perpetuate a more material deceleration in corporate earnings growth. And so that's one of the things we're tracking as well in that table and in our analysis. Again, it's about looking at the process component is about looking at the same set of indicators that have historically, back tested very well for identifying where you are in the cycle, both on a short-term basis, i.e. what quad you're in, but also on a longer-term basis, i.e. are we heading into recession, or are we heading out of recession, or is it what inning we're in? And being able to look at those things across the consistency, in terms of how you score it, that is how you ultimately identify, what asset classes you need to be in and how much exposure you want to have. All right, let's get a couple more before we wrap up. Kind of shifting gears again, because I think hopefully we've beaten this sort of concept of excess liquidity. Everyone says excess liquidity. I just say excess laziness. That's all it is you're using the Fed to sort of, to put you in an exposure that, it might do well, but it might not be the right exposure at the right time, or at the bare minimum, you might get completely, you might be passing up a better risk-adjusted opportunity to make a lot more money somewhere else because you didn't show up to work that day. And so that's kind of the whole point, tongue-in-cheek, excess liquidity equals excess laziness. But I think we've beaten that horse to death. So let's move on. A couple other questions. How does your process deal with something like coronavirus? I think that's a really good point, because you're obviously a longer-term investor.
Yeah. Well, I think that it's one of the. I think it's one of the criticisms of fair criticisms of my process is always that, well, the data that you're looking at doesn't include the thing that happened this morning that's in the news and the impact of that. And that's true. You can never say that that anything that happens on a given day that isn't in the charts that I'm looking at is going to be a complete game changer. But historically, the way I see it is that historically these negative events, really don't cause the end of the business cycle or cause recessions. They tend to exacerbate them if you're already in one. 9/11 is a good example of that. If you look at the data, the economy was clearly already rolling over.
Lehman was another
example.
At that
point. Yeah, and so these are things that exacerbate declines, and they're good. They make good narratives. They make good kind of simplistic cause and effect narratives that people tend to gravitate towards. But historically, if you look at SARS or the Ebola outbreak, how many people remember the Ebola outbreak? That wasn't even that long ago. Yeah, 14.
Yeah, October 14.
How many people remember the beginning of World War III from a month and a half ago.
Yeah, no one does. Yeah.
You know, so these things have a way of kind of. I don't want to diminish the impact of these things. Obviously, they're very significant to real people in the real world. But from the standpoint of looking at it as an investor, a portfolio manager, looking at the impact on the economy, generally I think these things are relatively limited. But you know, I went to a lunch with the chief economist of a bank the other day, and to him it's a very big deal because he's, you know, and maybe to you as well, because he's, you know, granularly forecasting Q1 GDP growth for Australia. So that's a big impact, you know. To my way of thinking, which is bigger picture, the question is really, is this something that's going to end the business cycle?
Yeah.
And I think it's unlikely. So, you know, SARS, Ebola, Fukushima, I think is a good analog here because that was a supply shock to a huge economy.
Massive, yeah, exactly.
2011 in Japan. Those things don't really, they're not the dominant driving force behind business cycles in my view.
Yeah, no, I would tend to agree with that as well. And for us, it's more about, if you throw slide 6 on before we wrap up, throw slide 6 in the macro themes deck showing our growth inflation policy model for the U.S. economy. For me, it's not about, because again, we would definitely tend to agree with you. The business cycles recessions aren't catalyzed by shocks. Everyone wants to say that there's a black swan, there's black swans, there's black swans. No, they're white swans. It's a regular old swan. It's called the business cycle. Unit labor cost inflation and running at an output gap that's well in excess of your growth potential. And oh, by the way, the Fed tightening into that is what catalyzes the recession. And so all these sort of black swan events, coronavirus, et cetera, yes, they have an impact, but they don't necessarily catalyze a recession. To me, it's about, when I think about things like coronavirus impact, it's about putting that chart back up on the screen. How far do these dots drop into the quads? So right now, I think we can all agree that the directional impact of coronavirus is negative, which means those forecasts for 2Q and maybe even 3Q and potentially even 4Q, who knows how long this thing lasts, the risk is to the downside, i.e. growth will slow faster than what's implied by those forecasts. And it's really just trying to wake up every day, sequence the data, sequence the incoming market signals to say, okay, what's the probability of that dot, looking at that 2Q dot, which is narrowly in quad 4, what's the probability of that going to the one that's at the bottom left of that corner, Q4 of 18? We all know exactly what that, what that meant for financial markets. Are we going to go test that out? Are we going to sniff that out? And what's the probability of that rising or falling on a daily basis? And that's kind of all we can do as investors as it relates to these more sort of non-modelable exogenous shocks.
Yeah.
Cool. All right, Nick, that was awesome, man. I love talking process.
Likewise.
I think it's really important as to what we're going to be doing with these segments is just really digging into process, digging into how investors do it. What's the repeatable nature? What's the robustness about their data that they're tracking, and ultimately how do they derive their investment conclusions? And I think from that, you just naturally the investment conclusions fall out of that. And so we'll catch you back here next time. Thank you guys for joining us this afternoon. Cheers.